Well, good evening, my Tuesday King family. How is everybody today? I am fine. McGwire was on yesterday, so we're going to watch that. Some good news for us. Again, he says, okay, all the players are out, and, something with this James Bank or whatever it's called, James Bank. We're kind of coming in and shorting, but all the shorts are basically done. And, and again, we go, yeah, we've heard this before. So we're waiting for comex to drop and finally get to the point. So let's take our first look at gold and silver as we always do. And gold, our gold's down to 41.51. It was 43.70. And all of a sudden at 2 o'clock, it drops. And here we go, 41.50. All right, not bad. It looks like it's not going back down to 4,000. And again, McGwire will explain it. Silver, this is absolutely a joke. It's just lost $6. Why? Who's doing this? It's got nothing to do with physical selling. Like I think it was India sold 15 tons of gold to China. It was really a loan, and they got it back. And that wouldn't make the paper price go down because it's being bought. The physical is being bought by China. See, in options, you short the option and you go, well, it's at 41.51. I'm going to short it. And with 1,000, and it's times 100. So if I short 100 ounces, it's really 1,200 ounces. It's 100,000 ounces that I'm shorting, which I don't have, which are out of thin air. But the difference is this is made for they're trying to suppress the price. There's no buy and sell at the same price. In other words, here's an apple. I'm going to sell it for $2. Oh, you're going to buy it for $2. The price is $2. In comex options, I'm going to short it at 4,200, but there's no buyer at 4,200. The buyer comes in at 41.50. 41. That's why you see these drastic drops. There is no buy and sell. It's not a market. It's a price suppressant thing, and that's how it was created. And it was created to keep the gold price down, to keep you in the dollar, to make you think the gold doesn't have a value. Well, gold's got no value. It's 41.48. It's got no value. But they're wrong. It has a great value. But when you're trying to sell, if I'm trying to sell apples, I don't want the competition also selling apples. So I'm going to say, oh, these are the best apples. Their apples are no good. And oh, I don't want to buy them. I'll buy yours. Then I can raise the price. And that's what a lot of advertising is. Oh, it's Mercedes. Oh, there is no substitute. Porsche. There's no substitute. Ferrari. So you want to buy that, so you'll pay for it. You'll pay more for Mercedes than Toyota because it's a Mercedes. And there's certain brands. Polo tries to do it. As you can see, I'm wearing my Nautica. They try to do it. So, I don't want to buy the others. They're inferior. I want to buy a Polo player. Who gives a fuck? And that's what you have. You see it in the NBA with the jerseys. I'm sure the Doyle Brunson jersey has gone up in value, or more people want it than the Winnebago jersey because he's a loser and he's an idiot. And so I think it becomes a demand thing. So you're trying to create demand by doing the, say, hey, it's Mercedes, it's the best. And everybody wants to buy one. So you raise your price and demand's high. And the demand says, I don't care what it sells for. I want to buy it. So that's a lot of what marketing is. Marketing is something, it's creating demand. You have the supply, but you need it increases demand. That's what marketing is. And of course, that's what time travel is. The demand to go back in time and buy manual cards. So that's really what you have here is you don't have a market in comex. I'm teaching you about markets. Like in Vegas, there is no market for a resort fee. There is no market to pay for parking. There's no market to buy expensive drinks. The market for drinks are free. In Vegas, I'll gamble. So what Vegas is doing is what Tesla did, which is creating a false demand. There's no demand for electric cars. There's no demand for, that, and they're trying to create a demand. They're making things that don't have a demand. And they're trying to sell resort fees and at Caesars is only $80 a night. River City at Lake Michigan, I go into booking.com and I go boom and I go, oh, there it is. It's going to be $100 a night, 4 nights. It's $400. That's what I expect to pay plus tax. Not, oh, well, there's $400 in resort fees that you're not being shown, and you're just, we're going to scam you, and nobody wants that. Welcome, page 2 billion. I don't think I've seen you before, unless you're one of the things, but top of the morning to also to you. Feel free, questions or comments. This is an open class, mostly economics, Austrian economics, not the Keynesian crap, and football, basketball, baseball, whatever you want to talk. So please feel free to jump in. I know what these, like the usernames, like Pat. We've known Pat for years in Singapore, but when he came on yesterday, the day before, it wasn't Pat again. It was some email address. So I apologize if I don't recognize your name, but anyway, welcome to you. So again, we want free market gold where there's a supply and a demand at the same point. You want to sell your gold for $10,000, there's a buyer for $10,000. That's free market. This bullshit, all right, he just, like what happened here at 9 o'clock, 41.80 gold, and then it goes down to 41.48. That's not free market. The guy's selling it at 41.80. There should be a buyer at 41.80. Where's the buyer? Oh, he's not. He's down there at 41.48. What kind of crap is that? That's the problem with comex. It's fixed, and they don't have any physical to back the options. So we're going to get into MMcgwire today. I got to watch him twice because I find that the way he talks, your focus goes out. Like you can focus with him for about 10 minutes and then you start to wander because he just monotone and a little technical, and you're like, what the fuck you talking about, Mark? So you got to watch it again just to get it all. I'm new and came here yesterday just watching and learning. Oh, well, please welcome. Not a problem. Again, just ask whatever you want. So I go through mostly gold and silver, Austrian economics, which is Adam Smith. Adam Smith's like the creator, and he kind of watched and he noticed the trade. And what money is trade. I'm going to trade this for an apple or a banana or a hamburger or a shirt or glasses. I'm trading this. That's what this is. Until you fuck it up and print so much of it, it has no value. So this is based on having value and trading the value. So if I want to buy gold, instead of $35, I now need $4,151, and the guy's going to charge me a premium. And the same thing with silver and how it's being manipulated. But that's how it is. The market controls the prices is what I kind of teach. So in other words, you go to Kroger's and they got New York strips for $20, but nobody wants to buy them. So they can price it at $20, but the market says, fuck off. We're not going to pay $20 for it. And then last week I saw them on sale for $13 and I bought some. And that's what I wait for is the sale, because the $20 is not a fair price. All our trades are fair trades. So I have this Bobby Bow card, and Bobby is in our class once in a while. He hasn't been in a while. So let's say this is worth $100. So a fair trade is give me $100 for it. You can have the card, and I want the money. That's a fair trade. That's what we're trying to do. So when you go to the grocery store and there's a $20 New York strip, it's not a fair trade. Nah, I'm not going to pay $20 for it. And if the market rejects it, guess what? The grocery store has to lower their price because they can't sell their inventory and they'll go out of business. So they got to lower their price. And you always, this is market and here's price. You always have to find market. Otherwise, who are you selling to? So I use my barbecue restaurant. If they have a slab of ribs and they want to sell it, it's $30. There's a market. I told the guy, if you want to go to 45, there's the market's at 30, you're at 40. Who are you selling to? There's nobody home. You'll go out of business. So he's never raised it. I think he maybe went from 30 to 31, but he's never raised that price and he's still in business. And 2 other of his restaurants went out of business because they didn't follow that. People are very price sensitive, which is the fair trade. I'm going to trade my dollar. I want a fair trade. That's why Coca-Cola, you see, for $3, and nobody's going to spend $3 on a 2-liter Coke. So what they do, the Kroger's puts it on sale 2 for $5. And then, okay, it's $2.50, but I get 2 of them. Okay, I'll buy it for that. And I've had discussions with the managers. They're going, your prices are way fucking high. You don't know what you're doing. You don't put it out and then put it on sale every week. Half the grocery store, I go to a Meijer's also, is on sale. It's buy 3, 1 free, because they can't sell their inventory, so they have to do it like that. Anyway, so this is just, now there's Jane's Street or something. I don't know. It's a new one for me. And they're the ones who are shorting this, 41.48, 64.56. Again, gold is not something you want to sell but it is available to sell. In other words, I bought and bought and bought with no intention of selling because I know the dollar's worthless. The dollar's going out. I listened to this McGregor guy. He actually used my Titanic analysis. So I guess he's listening to me. But in the Titanic, it doesn't matter. You've got the iceberg hit the ship. It's going to sink. It's not maybe it will. And then you're going to ask me, well, how long is it going to take to sink? And I'm going to tell you, well, we'll find out, but we know it will sink. And it took, let's say, 7 hours. That's the point. So once you see the iceberg hit, it's not will it sink, it's when will it sink. And you get into the lifeboat. And our lifeboat now is gold and silver. And that's the lifeboat because the dollar has hit the iceberg. It's sinking. It's sunk. And that's it. So that's why you get out of the dollar and you buy gold. But if you profit take gold, you're back in dollars. So it's like getting off the lifeboat and getting back on the Titanic before it's sinking, but you know it's going to sink. So you never want to really sell your gold and silver, although you can if you need a few $100s and you have nothing else, then yeah, you go ahead. You want to go on a vacation. Okay. So I'm going to sell an ounce of gold and get $41.50 for it. Take the $41.50 and I need cash, and then you have it. But you don't want to sell $20,000 worth of gold and have $20,000 in cash because cash is the Titanic. Cash is sinking, so I don't want to get back into it. I'm not here to profit take the gold and silver. But if I do need cash, I can easily sell it. There's 3 gold stores around me that one will take 96, one will take 94, one will take 98. So I'm going to go to the 198, but I'm waiting for gold to go back to 4,500, which apparently it's going to go to about 10,000 soon. And we're just stuck with this. What the fuck's going on? Why is it dropping? This is paper. This is not physical. This is options that are going down. Nobody's selling their physical. And if they did, it wouldn't move the price. So if I have 100 ounces and I sell them to China, why would the price go down? I'm going to sell them at $41.50. They're going to buy them at $41.50. There's no movement in the price. There's no sale. They're not buying them for 3,800, and we got to lower the price. No, it's so when they say Turkey sold their gold or India sold their gold, it goes to China and then it came back. So it was loaned to China and then they bought it back from China, probably at a little commission for China, of course. And that was it. China probably hoped they couldn't pay it back, but that has nothing to do with the COMEX price. All right. So we will get into that in a minute. Let's look at our baseball from yesterday. So we get in, I pick baseball. I'm really good at picking football, and we're waiting on that to come in. And let's look at baseball yesterday. We got Oakland 5, California nothing. I don't have a play on that. These teams are kind of hard to pick. I think, yeah, the over-under was 10. And I think I said this is this is not a 10, but I couldn't play. I think Oakland had a pretty good pitcher going. Or no, they had Jump going, but California I think they had Soriano going. So it was kind of like, how are we going to get the 10 on that? The Blue Jays 4, Boston 3. I did have Boston under 9.5. That was a winner. Cleveland 4, Milwaukee 2. Not the Aces. The Aces going today, Mizorowski. And the total was 7.5. I went over because I thought the total was low, and I was kind of shocked it was a 4-2 game because Milwaukee hits really well. So I did go over 7.5 just because it was, I thought, low. The pitchers were like 4.0 ERAs. I said, well, we got to get more than 8 runs in this game. Now we use the same logic for Minnesota and Texas, and the spread was 7.5, and the pitchers were 4.5. We went over 7.5, and Minnesota won 9-3. So it worked there. It didn't work in the Milwaukee game. So we win on that one over 7.5. We do the same thing with Seattle. This was 7.5. And I was shocked. Neither pitcher was all that. And I'm going, well, this should be an 8, just like the Texas game. And Seattle wins 3-0. So I was shocked. Philadelphia and the Mets, we were betting against Painter, and it was either take the Mets or go over, and I went over because I know I'm always scared of Philly scoring a lot. So the Mets won 6-4. Painter is now 1-11 his last 12. So Philly goes over 9. That's a winner. The White Sox and the Yankees, this was the free play. I went over at the Yankees. Again, neither pitcher was all that. Total on the game was over 10, and the White Sox went 5-1. Now, the first 2 games of the series, I went under with the good pitchers of Chicago, and the Yankees put up 10 runs in both those games, and it went over. So I'm figuring, okay, the pitchers are not as good as they've been. Dean Martin was going the other day, and it went over. So here's 5-1 White Sox win. I was just stunned. The Kansas City 14, St. Louis 6. I don't play the game. I don't like the pitchers. And the last game was Atlanta minus 136 is 2 units, and the game's postponed. So no bet. So I have 3 winners and I have 3 losers. A minus 2 units because I put 3 units on Milwaukee over and 3 units on the Yankees over. So when I play a lot of overs and unders, I don't like the pitchers. And I see these high ERAs, so I assume it's going to be a high-scoring game. So I go over there. When I like the pitchers like I do with Mizorowski today, then you'll see me play the team. And I prefer playing the team with the pitcher. All right, let's go to today's games. And I go to covers.com because covers.com gives me the pitching matchups that I want. So it's Gausman against Brown in the first game. And this game's at 220. All right, so I know I got to that. Chicago, the Cubbies, minus 116 and 7. I don't know if the wind, it's very windy here, so I don't know if the wind's blowing in or it's just you got 2 aces going. Gausman with the 3-4-1 against Ben Brown, who's got a 1-5, and he's a real 1-5. This guy is a very good pitcher, and that's what you want to bet on, the good pitchers. So Gausman is 4-2 his last 6. He pitched his last 6. He's got 6 innings of, he shut him out, 6 2/3, gave up 1 run. 5 innings gave up 1 run. 6 innings gave up 4. 5 innings gave up 4, and 7 innings gave up 1. He gave up 4 to Baltimore and Atlanta. He only gave up 1 to the Yankees. So he's a pretty consistent pitcher. He's had kind of 4 bad games. He gave up 4 runs. He gave up 7. He gave up 4 and 4. Otherwise, he shuts you out or gives you 1 run. Who did he give up 7 to? Tampa Bay got him for 7 runs. Jesus. That's crazy. So anyway, he's fairly good. And now you go to the hitting. What kind of hitting does the Cubbies have? And I don't think they hit very well. So I have their batting over here. And the Cubs have 4 hitters who hit over 245 and 4 hitters who hit under 220. So not the greatest of hitting. You're not going to hit Ben Brown. So the question is, do we bet Ben Brown or do we bet the under because Kevin Gausman's pitching? And I know what I'm doing. So I sell my picks for $25. I will give you a free pick. So really, my rule of thumb is if it's ace against ace, I like under. If it's ace against the 5th starter, I take the ace. And if it's 5th starter against 5th starter, then I like the overs. This is probably ace against ace. Gausman has always been a pretty good pitcher. 3.4 ERA. I don't know. Maybe the wind's blowing in at Wrigley, or maybe it's just Ben Brown pitching. So I think the Cubbies will win. Because this guy is just damn hard to hit. Looks like a big pitching day. We got the White Sox at Detroit. This is 640. We got Detroit minus 185 and 8. We got Fetty for the White Sox, 4.38 ERA, and a righty. And Detroit hits much better with their left-handed lineup. Against Skubal, the crybaby, with the 2.81. Let's look at Fetty. He's won his last 4. He's given up, but he's pitched a lot of 3, and he pitched 3 innings, gave up 4 runs. 3 innings, gave up 8. 4 innings, gave up 2. Then he went 5 and shut out, 5 and 2. And then he went 2 and shut out. And that was 58 pitches to go 2 innings. This guy, he walks a lot of guys. 4 walks, 4 walks, 3 walks. So he gave up 8 runs against the 49ers, which is, they don't really hit that well. He hasn't against Detroit. He did beat Detroit 4-3 in 10 innings. I'm looking at it. He pitched and the team won. Not necessarily he won, but the team won. So the team won the last 4 that he pitched. Against the Dodgers, he pitched 2 2/3, 3 hits, no runs, 4 strikeouts, 58 pitches, and they pull him and they win 6-4. So I don't know what that's about. So he's normally a starter. He's gone 103, 90 pitches. Does have some walk issues. So an average pitcher going against the Tigers, Skubal with a 2.81. I call him a crybaby because after 5 innings, he wants to take his ball and go home. I wouldn't pay this guy $40 million for 10 years if my life depended on it. The most I would do with this guy is a 3-year contract with incentives. You win 20 games, here's $1 million. You strike out 200 batters, here's $1 million. God forbid you go 8 innings a game instead of the 5 you go, here's another $1 million. And I would incentivize him to pitch more than 5 innings and go cry. And, I got to come out. I hate losers like that, obviously. So he just came back June 13th. He pitched 4 2/3, 5 hits, 3 runs, 4 strikeouts, 1 walk. He pitched 80 pitches in 4 innings. I noticed that with Skeens a lot. He pitches 5 innings and he goes 95 pitches, and they're too reliant on the pitch count. Fuck the pitch count. I'm sure Paul Skeens can throw 150 pitches. Let him pitch 8 innings because the relievers you got are not as good as Skeens. And here in Scooble's case, let the guy, because he's not going to pitch for another 5 days. He got hurt. He hurt his elbow. Had no, wait a minute, you're babying him now, and he hurt his elbow. So I don't buy any of this bullshit. 100 pitch count again. This analytics. Well, it says 100 pitch. It's bullshit. Nobody asks, is it real? And is it, and yet you see all these pitchers getting hurt, and they're down to 100 pitches and every 5 days. And guess what? It doesn't work. You'd probably be better if you let them pitch 150 and pitches and strengthen their arm so it doesn't get hurt. I would go back to the 1960s. You're pitching every 4th day, and I'm watching World Series game, the Dodgers in Minnesota, and Koufax pitches the whole game. And Bob Gibson in the 68 World Series against the Tigers pitches 3, on 2 days rest, and Mickey Lolich pitched a complete game on 2 days rest. I mean, come on, these guys can pitch. I played baseball, not professionally. I could pitch and pitch and pitch. I mean, you don't get tired. So anyway, that would be my thought. So Scooble, can we trust him? I don't think so. His ERA is pretty high at 2.81. I think he's just pitching to be traded, and I wouldn't trade him. If I'm the Tigers, I'm just letting him walk. And then I'm going to take the $30 million I would have spent on him, and I'm going to get 3 $10 million pitchers. That's what I would do. And they need some hitting. So I'm going to trade half their team for hitting. This McGonigal and this Ricky Green, and they're all traded. McGonigal, you can't trade him. Why not? You're not winning with him. He's a shortstop. He's a good go-with piece, but he's not Vladimir Guerrero. He's not the guy on the Indians. He's not Bobby Witt Jr. That's what you need, is that star, and he's not the star. So as far as I'm concerned, I would what am I going to get in a trade for Scooble? Who's going to give me anything? Nobody. Just let him walk. Take your $30 million and go buy 3-4 good players. A good hitting outfielder and maybe 2 pitchers. And I'm way ahead, because what am I going to get for Scooble? Oh, I'm going to get prospects. Well, we all know how prospects work. These guys suck. That's why they're in the minor leagues. How many minor leaguers do you see are any good? Unless it's a Mizorowski or a Scoop or a Skeens, and they're a great player, and they don't last in the minor leagues long. So what do I do with this game? I actually probably like it over under. But Scooble can always throw that shutout, but I doubt he goes more than 4 innings, because they want to trade him, so they don't want to. I wouldn't play him at all, because he got hurt. That's the reason that I can't trade him if he's hurt. So I wouldn't play him. So again, this is, I'm almost going to, Detroit, they don't hit, although they'll hit a righty better. So maybe this goes over 8, but I don't, you can't trust Scooble, which Scooble, like he could shut him out and then you're fucked. So I'm going to watch this game, but I'm not going under with Scooble. So no bet there. Cincinnati and the Yankees. Here's your free play. We are taking the New York Yankees, 2 units. We've got Lauder for the Reds with the 4.6 ERA against Steve Schittler with a 1.82 ERA, their best pitcher. It's in New York. Cincinnati has not been hitting. This pitcher for Cincinnati has lost 4 out of his last 5. And his stats, 5 innings, 2 runs, 1 inning, 8 runs. 1 inning, 8 runs, 52 pitches. Why is the manager leaving him in there? giving up 8 runs in an inning and a third. What are you kidding me? 3 innings, 3 runs, 3 innings shutout, 5 innings, 1 in. So this guy stinks. And the Yankees should hit, and Schittler should shut them down. Cincinnati's not been hitting lately. So your free play takes Schittler and the Yankees 2 units. So that's how I work. That's your free play. If I give you something now, I am a handicapper, mostly football, and I do charge for that. And I still give one free play when we get to football season. And I'm very good at football. So this I'm getting better at. So here's your free play. But if you want all the picks, it's $25 for a week. I keep it very nonchalant because there's so much baseball. It's every day. But I am figuring it out. It's the pitcher, and it's like the last 5 or 6 games is what it is. And then can the team hit or not? Like Pittsburgh, very good hitting team. I bet them over quite a bit. All right, Washington at Tampa. We got Tampa minus 121 and 7.5. I'm sorry, Schittler was 262 and 9. And I don't care about the 262. If I'm going to win, what's the difference if I lay 110 or 262? I'm only laying it with Schittler or Skanes or Mizorowski, and we'll get to that soon. So Tampa 121, 7.5. Again, this is one of these 7.5s that you're going, that's awful low. Cavalier for Washington, 4.01 ERA against Jacks, Tampa Bay, 257. Chevalier, no real streak. 7 innings, 2 runs, 6 innings, 1 run, 5 innings, 2 runs. Then the last 2 games, 5 innings, 4 runs, 5 innings, 3 runs. So I don't know if he's getting tired and they start giving it up, if they start seeing he throws a lot of fastballs and they wait, and then he gets a good fastball hitting team and they hit him. I don't really know the story of what's happening, but he did win the last game 8-3 over Seattle, even though he gave up 3 runs. So he's pretty much, you're going to get 2-3 runs off of Chevalier for the Redskins. And then Tampa, the Bucks, we got Jacks, 2.57 ERA. He's a bullpen guy. He's lost his last 4. And his last 5 games, 5 innings, 1 run, 2 innings, 3 runs, 4 innings, 6 runs, 5 innings shutout, 5 innings, 1 run. He goes, well, I don't know, he's 38 pitches, but he goes about 60 or 70. And he gets a lot of strikeouts. And then in one game with 4 walks, but usually he's 1 or 2 walks. And the game he gave up 6 runs was to the Tigers, and they lost 10-9. So in his losses, gave up 3 runs, 6 runs, 0 and 1. He goes about 5 innings, about 70 pitches. So then you're dealing with the bullpen, and I think Tampa's got a pretty good bullpen. Tampa's inconsistent. You don't know if they're going to score a lot or get shut out. Against Cavalier, they should score. Jacks should give up. Again, this is another one where I think the total is too low. The 7.5s are Mizorowski, Skanes, Chris Sale. Those are the pitchers. The guys on Philadelphia. The other guy on Milwaukee, Sanchez, and the Milwaukee guy is Harrison. I get those should be 7.5. But Jackson Cavalli, 7.5? Yeah, I don't think so. All right, 49ers against Miami, Super Bowl. God, they just played like a week ago. And they just made a pitching change. I'm looking at it. That's crazy. Buy me 111-8. Roop for San Francisco, and Roop has lost, I think, 8 in a row. Let's double check this. He's got a 4.26. Bachner, who's a reliever, with the 129. So you see 129, you go, oh, it was a good pitcher, and then you realize he only goes an inning or 2. Now he's just a reliever, and now you're fucked with who's coming in and all the whole reliever bullshit. But Roop has lost his last 1, 2, 3, 4, 5, 6, 7, 8. So we are betting against the 49ers. He gives up his last 6, 5 innings, 4 runs, 6 innings, 1, 5 innings, 4, 4 innings, 8, 5 innings, 1, 4 innings, 4. So he gives up a lot of runs, hence the 4.26 ERA. Now Miami has gone to a pitcher to be determined, so they're not going with Bachner. This is weird how this just changed to TBD. So I don't have a pitcher. Miami's favored by 111. And so here's where we look at the pitcher streak. Root lost his last 8, or let's put it this way: the Niners have lost the last 8 times he's pitched. That's what we like to do is the streak. So we've got to do that. All right. Milwaukee against Oakland. We've got Milwaukee minus 159 and 7.5, but only here it's Mizorowski with his 1.34 ERA, the best player in the league, the Cy Young winner, the MVP, goes against Martin Perez. 3.12 is a pretty good pitcher in his own right. So you can't bet against Mizorowski. Perez is a pretty good one. Let's see if we got a streak on Mizorowski. Jacob Mizorowski, 6'7", 24, from Maryland or from Missouri. He's a show me guy. And he's won his last 5. It doesn't matter. We're going to bet him every game anyway. But here's what we like about Mizorowski. If you go into the stats, all right. It's the run number, right? 0-1-0-1-0-0-0-0, and then a couple of 3s somehow way back in April, and one was to Pitt, which makes sense. So he shuts out the Yankees, shuts out the Phillies. It's like he pitched a complete game shutout, 1 hitter against the Phillies last time, 9 innings, 95 pitches. So he's our new god. We are praying to Mizorowski. He can put food on our table. Martin Perez, he's pretty good too. He's won 4 out of his last 5, and he gave up 4 runs, then 1, 2, 3, and 1, and so he gave up 4 runs to Miami of all teams. Jesus. But this should be he's at home, and this is going to be a very, strong test for him. He wants to look good also. He's a pretty good pitcher, but when you face a Mizorowski, you're going to say, look, I can pitch too. So it's a big challenge for him. So I mean, see, this is what I like. Mizorowski's only a 159. Our bet was with Schitler was 240 or something like that. Mizorowski's a better value at 159. Ain't nobody beating him. Ain't nobody can hit him. 6'7", and it says a 1.34 ERA. Thank you, God. We found Joe Montana. So Perez, so could be an under, and you got to bet Mizorowski. I mean, this is just crazy. Now, I'll make this the second free pick. Let's go under in this game because I do like Perez, and this will be a 3-unit play. But you expect Mizorowski to shut him out. You expect him to win. So you can bet him to win, or you can bet the under 7.5. Dealer's choice. But so this will be the second, and you just got to bet him. I mean, if you can't understand that, you got to bet Mizorowski with the 1.34, and he's the best player in the game. If you can't figure that out, you shouldn't be betting. So always understand your bets. In this game, it's Mizorowski. If we lose, we bet Mizorowski, and we lost. That happens. But you've got to bet them. It's like betting Koufax or Bob Gibson. You got to bet them. They might lose, maybe. It's funny with Koufax. All he had was this 100-mile-an-hour fastball and a slow curve. That was it. There was no screwball and curveball and rise ball and drop ball and all that. And just that's how good he was. And when he threw that slow curve, you had no chance. And then you come back with the fastball, and you had no chance. So that's the game of the day. That's 7:15. Mizorowski against Brown. I'm debating about doing both, but I'm giving you dealer's choice. So you can take Mizorowski or take the under. I think both plays are good plays. San Diego and Texas. Very good game here. We got Texas minus 155 and 7. So again, that spread was Milwaukee 159 and 7.5. San Diego at Texas. Texas minus 155 and 7. We got Vasquez 3.65 against Jacob deGrom 3.2. It's not the same Jacob deGrom who's on the Mets, but he's very capable of shutting you out. So let's get Vasquez from the Dominican Republic. And he had a 4-game losing streak. He just beat Baltimore, so he's 1-4. His last 5 games, 4 innings, 3 runs, 5 innings, 4 runs, 5 innings, 2 runs, 4 innings, 4 runs, and 5 innings, 2 runs. And that was 100 pitches, 99 pitches. God, I don't know. I don't understand this pitch count. And 4 runs he gives up to the Jets, and 4 runs he gave up to the Phillies. That you understand. 2 runs to Baltimore. They did win 9-3 there. So not a bad pitcher, but he gives up runs. deGrom, we love deGrom, but he just isn't. He's not back. He lost 3 in a row, won 2 in a row, and then lost. So he's 2-4 his last 4. Let's look at his last 5. 3 innings, 6 runs, 6 innings, 2 runs, 5 innings shutout, 6 innings shutout, 6 innings, 2 runs. So the last 4 is good. Before the 6th run, he gave up 4 runs. And let's look who beat him. The fucking California beat him 9-6, and Houston 4-1. That's crazy. They don't hit. So he hasn't played very good. So the Yankees, he played twice. He lost both. Gave up 6 runs and then 1 run. So okay, that makes sense. But giving up. They beat Cleveland. They can hit. Boston doesn't hit. St. Louis, Houston, not much of a hitting team. So he's beaten 4 teams that really don't hit much. And here he's going against San Diego, who I don't think hits much either. San Diego, 3 good hitters and 5 shit hitters. How do these teams have 5 guys that can't hit 220 in the lineup? It's amazing. Could be injuries, I just get into the numbers. I'm not really – I wouldn't know the starting shortstop on San Diego. Or maybe I would. It's Xander Bogaerts, I think. That's the problem. Xander Bogaerts and the other guy who are very good players, I think Manny Machado, they're both hitting like 230. That's the problem. I'm noticing George Springer at Toronto is hitting 210. So all the good hitters that are not hitting 275. They're hitting 200, 220, 230. And then the guys you don't know are hitting 350. So I don't know what you do with this game. deGrom, you don't know what you're getting. Probably shuts them down. Vasquez can give up a few runs. I don't know. You could go over, but you don't want to go over against deGrom. He can just as easily shut you out. Then you're fucked. So I gotta take a pass there, Bennett. Houston, 117, 8.5. We got Tanner Bibby, 3.96 against Jaime, 6.43 for Houston. The Tanner Bibby for Cleveland, beat Detroit last time out 3-2. He's last 5, 8 innings, 1 run, 3 innings, 7 runs, 6 innings, 3 runs, 8 innings, no runs, 7 innings, 2 runs. What the fuck happened there? Washington beat him 10-2. He gave up 5 home runs, 61 pitches. Why is the manager leaving after maybe 2 home runs? You go to the shower. You wait till he gives up 5 home runs in 3 innings. What kind of manager is this? But then he came on. His last 2 games, 8 innings shutout, 7 innings, 2 runs. That was against Texas, and then Detroit. He gave up 2 runs. Detroit doesn't really hit. So again, he gives up 3, 7, and then shutout 2. And this is the problem with most of these pitchers. That's why we like Mizorowski. It's 0-0-0-0-1-1-1. You don't hit the guy. And then you get Bibby, he gives up 5 and 6 and then shuts you out. And that's the problem with baseball. The consistency of what you're going to get and what you're going to bet on, you just have no idea. Aime for Houston. From Japan, he's a Mr. Fuji disciple. Let's see, his last 5. His last game, he went 2/3 of an inning, gave up 4 hits, 5 runs, and 38 pitches. Wow. So we go back his last 5, 4 innings, 3 runs, 6 innings shutout, 6 innings, 2 runs, 5 innings, 2 runs. 2/3 of an inning, he gives up 5 runs, and that was to Kansas City. So what do you do with this? This, I don't know. I mean, again, this is where the aces you go under and the 5s you go over. So this could be an over, but do they hit enough? Do Cleveland and Houston hit enough? And again, you don't know. I mean, Bibby could throw a shutout or give up 3 or 4 runs. I think they give up runs here. I can't like it. St. Louis at Kansas City. I think this was a real high-scoring game yesterday. St. Louis minus 114 and a total of 9. And this total, I question. McGreevy with a 3 against Seth Lugo with a 3.87. Michael McGreevy from California. And he's lost 4 of his last 5. His last 5 innings, 3 runs, 4 innings, 5 runs, 6 innings, 2 runs, 6 innings, 2 runs, 6 innings, 2 runs. So McGreevy is going to give up 2 or 3 runs. That's pretty good. We're pretty consistent. We're getting 3 runs from McGreevy. Seth Lugo, the total on the game is 9. Seth Lugo, no streak. His last 5, 6 innings, 2 runs, 6 innings, 3, 6 innings, 3, 5 innings, 5, 3 innings, 1. So he gave up 5 runs to Minnesota, 8-6. And then I don't know what happened against Texas. 3 innings, 3 hits, 1 run, 44 pitches, and they took him out. Looks like he pitches a lot of over games. So I think there'll be runs scored in this game. Total of 9. Again, I'm caught in the middle. I really don't know. Pittsburgh against Colorado. Here's a good game. All right. Pitt's a very high-scoring team. Pitt minus 132, 11.5. It's in Colorado. Chandler for Pittsburgh. Bubba Chandler from Georgia. Good old boy. Wow, he had lost 2, 4, 6, 7 in a row. Then he won, then he lost, then he won. So the streak's kind of over. Last 5 gave up 5 innings, 3 runs, 5 innings, 4 runs, 5 innings, 4 runs, 5 innings, 3 runs, 5 innings, 2. So it's perfect because he's going to give up 3, 4 runs here with his 5 ERA. Freeland. Let's see. He was on a 7-game losing streak, and now he's lost 1, 2, 3, 4, 5, 6, 7, 8, 9. He's 1-9. So his last 10, they've lost 9 of the games. Some are pretty high scoring: a 15, a 9, a 12, a 7, a 9, a 9. Last 5, 4 innings, 3 runs, 4 innings, 8 runs, 5 innings, 6 runs, 5 innings, 3 runs, 5 innings, 6 runs. You got to love this guy. So do we bet Chandler or do we bet over? Let's look at Bubba again. And Bubba's lost a lot. Okay. So we can't bet Bubba because he loses a lot, and we can't bet Freeland because he loses a lot. So we know where to go on that game. California and Oakland. Oakland at home -153 and total of 10. This is a weird number with Soriano, who's a pretty good pitcher for California. He's won his last 2, his last 5. 6 innings, 2 runs, 5 innings, 3 runs, 4 innings, 3 runs, 6 innings, 5 runs, and then 5 innings, 0 runs. And we go against Springs. Do we have Springs? Yeah, he was 1-6. Let's see what he's at now. 1, 2, 3, 4, 5, 6. He's 1-7, Springs. So Springs does not win. Last 5, 6 innings, 4 runs, 5 innings, 5 runs, 3 innings, 4 runs, 5, 5, 4, 8. Yeah, this is all right. So here's where we got the ace against the 5th, and the 5th gives up a lot of runs. The total on the game's 10, and I don't want to go over with Soriano. So there's only one way to play that game. Minnesota goes to Arizona. Arizona 162, 8.5. Big favorite. We got Prelip for Minnesota, 5.33 ERA against Soroka, 3.11 ERA for Arizona. Let's take a look. Prelap. 4 innings, 6 runs, 4 innings, 6 runs, 6 innings, 4 runs, 4 innings, 2, 6 innings, 4. This guy gives up a lot of runs. We're leaning towards the over. Soroka, Michael Soroka from he's a Canuck from Calgary. I thought all they had there was a Calgary Flames. Last 5, 6 innings, 1 run, 6 innings, 2 runs, 6 innings, 4, 7 innings, 1, 7 innings, 1. And he's 2-3 in those games, but doesn't give up a lot of runs. Okay, so this is so Prelap's going to give up 5, 6 runs. The total on the game's 8.5, but Soroka doesn't give up a lot of runs. So it should be a lock over. We can because Soroka actually can pitch and Prelap can't, which turns this into a team, or probably you got to stay away from the total. But it probably goes over because Prelap sucks, basically. And that's what we're looking for, the guys who suck. Like here's on Painter on Philadelphia is 1-10. But then they got Sanchez who's 10-1. So Dean Martin, my favorite on the White Sox. Do I have Prelap? No, I don't have him. All right. He's just bad. He doesn't lose every game, but he's not good. Boston goes to Seattle. This is a great matchup. We've got Boston, Seattle 107, 6.5. What a low number. And then you read the pictures and you understand. We got the Ranger Suarez going for Boston, 3.21 ERA against Bryce Miller, 1.20 ERA. Is he really that good? Let's see. Do I have him down? Let's look at it. The Ranger from Venezuela. He escaped the oil rig to the baseball field. Like these guys live in Colombia or Venezuela. When do they have time to play baseball? It's hysterical. The Ranger, let's see, his last 4 innings, 1 run, 5 innings, 5 runs, 5 innings, 4 runs, 6 innings, 1 run, 5 innings, 2 runs. So what the fuck happened there? He goes 90 pitches every game. Gives up 5 runs to Atlanta. They lose 7-6. He gives up 4 runs to Cleveland, and they win 9-4. Then he loses to the Yankees 6-1. He only gives up 1 run, and then he gives up 2 runs to Texas. They win 6-3. So what happened in the Yankee game? 6 hits, 1 run in 6 innings, and yet no walks, and they lose 6-1. Yeah, good luck with that. Philadelphia loses 3-1 on a shutout. He shut out Houston. He shut out Toronto. He shut out Detroit. So he beat some pretty well. He played good. I mean, he pitched really well against the Yankees and Philly. 5 innings, shutout. Really only had 1 bad game where he gave up 4 runs to Cleveland. And then the bullpen comes in. The bullpen must suck. Except for this 5-run game. That was Atlanta. He gave up 5 runs to Atlanta, 4 runs to Cleveland. So he had 2 bad outings, and then he's back to 1 run, 2 runs. And he goes mid-90 pitching. Not a lot. Yeah, he got in trouble. 3 walks in the Atlanta game when he gave up 5 runs. And he had 2 walks in the Cleveland game when they gave up 4 runs. But no walks to the Yankees, 2 walks last game to Texas. So real good pitcher, had a couple of bad outings, but I think he's back on. Seattle, Bryce Miller. Good old boy from Texas. He's pitched 6 games. He's 4-2. Well, the team's 4-2. So we'll read all 6. 5 innings, 2 runs, 5 innings shutout, 5 innings, 2 runs, 5 innings shutout, 6 innings shutout, 8 innings, 2 runs. So the most he's given up is 2 runs. That was to Washington. He shuts out Detroit. Shuts out the White Sox. That's impressive. Shuts out Arizona. And 2 runs to Washington, 2 runs to Oakland, 2 runs to Houston. So this guy does not give up a lot of runs. Oh, wait, let me check his other years. So in 2025, he had a 5.68 ERA. In 2024, he had a 2.94 ERA. 2023, he had a 4.32 ERA. So he can't make up his mind. How do you go from a 4.32 to a 2.94 to a 5.68 and a 1.50? And that's what we look at. He's got a 1.54. And wait a minute. That was this year? Oh, that was postseason. Yeah, 1.54. So this should be a very low scoring game. The problem is the total is 6.5. It's too low. 7.5, I go under. 6.5. It's like a total, like an Iowa game where the total is 35 in football. How the fuck do I go under 35, even though it is Iowa? It's just too damn low. Miller, I mean, this should be Boston can't hit. Seattle has 6 hitters over 245 and 1 bad hitter. So it could almost be a Seattle bet if you want to fuck with Ranger Suarez. And I don't like fucking with Ranger Suarez. So I think Seattle wins the game because they got better hitting. Now, if this spread goes to 7.5, take it under. But right now it's 6.5. No hablo inglo. In their last game, the Dodgers minus 203, 9.5 against Baltimore. T. Gibson for Baltimore, 616. Sasaki, one of the Mr. Fuji guys, 479. And we've got Trey Gibson for Baltimore has pitched 5 games, lost 4 of them. Let's go 4 innings, 3 runs, 2 innings, 1 run, 5 innings, 1 run, 4 innings, 3, 4 innings, 6. This guy, the Dodgers are going to hit the shit out of him. And Sasaki, 479. Oh, what's with all these Japanese pitchers on the Dodgers? And none of them can really pitch. 7 innings, 1 run, 5 innings, 3 runs, 5 innings, 1 run, 7 innings shutout, 4 innings, 7. So he's very inconsistent. Before that, he gave up 3 runs, 4 runs, 3 runs, 3 runs, and then it's been 1, 3, 1, 0, and then a 7 to the White Sox that killed them 8-2. He beat California 1-0. He did beat. They lost to Philly 4-3, 5 innings. He gave up 1 run to the Phillies. So the shutout was against California, who's not really into hitting. So I think Baltimore can score a couple runs. The Dodgers should pound him. This Gibson guy. We got 9.5. All right, that's what I'm gonna do. So that be baseball for today. Your 2 free picks. We're taking the Yankees with Steve Schittler, and we're taking Milwaukee under with Mizorowski going against who's the guy's name? Against Martin Perez at Atlanta, who's pretty good. So I think it's going to be 4-0 Milwaukee. He'll shut him out. They ain't going to hit on him. They're not going to get too many runs, but Perez is pretty good, so it'll keep Milwaukee down. So the best play here is under, and that's your free play. And then the Yankee game, we're going Schittler, and that's the advantage of the pitchers. You want to go with good pitchers because they're consistent. That's the problem when you go to these, let's look at Tanner Bibby against Aime. How do you bet that game? Tanner Bibby, he's got a 4 ERA, and Aime's got a 6. So maybe you bet that game over. You can't really bet on Bibby to win. He's not there. And then Houston. Altuve is back for Houston. We'll see. Cleveland's hard because they got a great bullpen, and they'll win the game 2-0. Depending on what the score is, they'll shut you down in the innings. So if you don't hit Bibby, you're getting the bullpen. You're not scoring, and so it makes it hard to go over in this game, even though it probably is. But it's Cleveland, so you got to know your team somewhat. And I'm still trying to figure out some of these teams, like in Arizona. I got Miami and Arizona as under teams, and I got Pitt and Milwaukee as over teams. Pretty much Philadelphia and over. The Dodgers are an over. And I really get that by looking at their batting averages. If you got a bunch of 280, 290, 300 hitters, you should score runs on average. But if you're facing Mizorowski, you ain't scoring anything. All right. So that's baseball. What did I want to talk about? We got Mark McGwire. We got one on GM. Let's look at Mark McGwire. He's our man. All right, so Mark McGwire today, Fed's gold revaluation. He's good. He explains a lot.
Do you want to know why you should buy this $40 AI stock? It's a
I don't want to know. I don't want to hear anything about stocks.
This shift proves gold is being treated as a strategic sovereign asset, not just a reserve holding. It's this simple.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew McGwire.
Welcome to Live from the Vault.
And we'll start by stepping through what was really an extremely overdue capitulative gold and silver bottoming action. And then, well, let's start with the larger picture and then really what to expect more immediately as well, because I know that's important. Now, in the larger picture, we'll just deal with that quickly first. Now, while the mechanically correlated cross-asset moves in gold versus the dollar, that is oil and bonds, etc., and having weighed bearishly on, and I will specify, on synthetic gold.
That's paper gold.
Throughout this entire flip-flop, on, off, 110 days war cycle, and it was on, off, it was all the time. I mean, but yet through this whole cycle, central banks, sovereign buyers, and the wider cohort of Asian safe haven physical gold buyers have all along been capitalizing on this disconnect between paper pricing and real assets. With no surprise, paper pricing is 100 to 1. Real assets and real physical assets are unleveraged. So really, what they've been doing through this whole time is adding very large size, both transparently as well as central bank to central bank, unreported monetary gold purchases. And we know, as we discussed last time, we know that when India put their gold up, it was leased to the PBOC. It is being bought back. So essentially none of this ever hits the market. So people that talk about, oh no, they've sold. No, actually, what gold did was act as the perfect safe haven because it was able to be cashed in instantly to meet your dollar shortfalls. So while everyone says, oh, it wasn't a safe haven, yes, it was. It absolutely was. Now, these guys that leased their gold back out, central bank to central bank, are buying it back. Now, what the Iran war exposed, it exposed really the US non-performance as the oil producers' protector. This was a big deal. So as we evidenced by the UAE, the incentive to use dollars to secure this protection just really diminishes. And China has trillions in official and shadow banking dollar FX reserves, right? So remember, we did episodes about that, talked about literally trillions in shadow banking reserves, as well as what's published. And while they've been exchanging dollars for gold for decades, the PBOC stepped up exchanging excess dollars for literally hundreds of tons of unreported monetary gold over the last 3 months. And as it will turn out, that it's going to be seen, this was at the Fed's expense. The World Gold Council surveyed 64 central banks, and 45% stated they plan to buy more gold in the coming year. Funding purchases through domestic accumulation programs, these reports back up what our liquidity providers has been reporting all along, and they continue to report. Missing is liquidity provider estimations of hundreds of tons of unreported central bank monetary gold accumulations. So more than 110 days into what was expected to be a 3-day conflict with Iran, it became clear that the US had significantly miscalculated. So cutting to the quick, the US and the wider West has begun facing unplanned increases in oil and commodity prices. Even though that's backing off a little, it's taken a long time to actually erode. And what it did is add to mounting stagflationary pressures. And this effect is increasingly being reflected in Western-facing gold, which was already beginning to break away from these bearish mechanical correlations before this week's peace deal looks to be getting signed. Now, a bit later, we're going to look at the mammoth-sized footprints left in the charts that mark the point where unleveraged physical buying overran the deluge of 100-to-1 leverage paper supply into the largest Shanghai spot premiums recorded since November 2008. We'll look at that in a little while. Now, but to finish up on the larger picture, it's now being realized that Iran has military, regional and strategic advantages over the US, including underappreciated missile capabilities alongside very, very strong support from China and Russia. Iran has now perceived to have the upper hand with the ability to maintain pressure on the US-linked bases, regional infrastructures, and key shipping routes, such as Hormuz, if the peace deal collapses, which likely means the US will do their utmost to ensure the peace deal will not collapse. The US has realized that any further escalations would really push oil, commodities, inflation significantly higher. Sustained energy shocks have already weakened the G7 economies. You can see it already, scrambling. Currencies, capital markets being weakened. It's already created an impossible to ignore bullish for gold, stagflationary environment, which will take a long time to exhaust. And flying under the...
Real quick, stagflation is high unemployment and high inflation. That's what the real definition of stagflation is. In other words, if you have real high inflation, you shouldn't have high unemployment, but you do. So nobody's working and the money is worthless and you're fucked. And that's stagflation. It's very bad.
It's a chart-painted bearish narrative, and we'll look at why it was them in a minute. So under all of this, the global majority has not wavered from its 6,000-year acceptance that accruing safe haven gold into uncertain times is the default position to take, and one that continues to strengthen. Asian physical gold demand offers a really small window, because that's, you can't hide that they've been buying gold. It offers us a little window into the wider scale of global South demand. Now, liquidity providers assess that the paper to physical imbalance has reached an inflection point that will force the unwind of a very large, impossible to defend short squeeze into rapidly depleting stock of what is 100-to-1 momentum hedges for the Fed to have to short cover into. So really, when the Fed is trying not to add shorts to their already deeply underwater position, what they're using is they're bringing in, allowing, incentivizing the wrong at both ends momentums. We'll label a couple of them in a minute. into taking a short position, then they need to cover into them, need to cover those hedges at some point. And before Asia does, it takes it all off the market. And the Fed is the only central bank still defending the dollar against gold. And liquidity providers assess that this war-induced tailwind, really, they got, provided them the very last throwback kick at the gold price suppression can. It's been going on a long time. But this time they were met with very, very large, unfactored, competing central bank, sovereign, and global south institutional physical demand. Quite simply, under the smoke and mirrors synthetic action, if you look at any chart, look at the chaos, the Fed has dug an even deeper hole ahead of Trump's renewed call to audit Fort Knox. Now, with COMEX open interest evaporating and institutional flows long ago migrated into physical exchanges, the only solution for the Fed to extricate itself from its insurmountable 60-year rehypothecated abyss is to fold its naked shorthand into a US Treasury gold revaluation event. And following the loss of face Iran war miscalculation, which even if the peace deal sticks, it will take a long time to recover, driving an unfactored debt-fueled bearish environment for stocks and bonds into stagflationary pressures. Not seeing it right now, but it's there. There's never been a better segue for the White House to sanction a US Treasury gold revaluation. One that will very well suit Bassent and the entire Trump administration. Now, this Financial Times piece from
So that could be what's going to happen July 4th. They'll revalue gold and come out with that 100-year bond backed by gold. And if they do that, they'll need a much higher gold price. So that could be right around the corner. I assume they're trying to lower the gold price to buy it, right? So if I want to buy gold, I want to pay less than more. So they're knocking it down. So they're buying. That's the only thing that makes sense here. So we look at it like, well, why is gold going down? Well, somebody wants to buy it, obviously. And so it sounds like the Fed, because there's no gold in Fort Knox, so they need to buy gold to then back these treasuries, which won't work anyway. But if you have the gold, just back the money by gold. Otherwise, you're fucked. So we have no gold in Fort Knox. Don't think we do. All right. So July 4th, it's a couple weeks away.
Today illustrates that global central banks no longer trust storing their physical gold in New York or London. And following the last 3 months of geopolitical uncertainty, they're stepping up repatriating their sovereign assets. It's taken decades, but Gatter's golden enveloping horn has fully encircled a trapped Fed. With gold having overtaken US treasuries as the top reserve asset, as trust in the dollar-based systems weaken, this shift proves gold is being treated as a strategic sovereign asset, not just a reserve holding. It's this simple. Central banks are moving their gold out of London and New York to reduce geopolitical and access risks. India and France are among the biggest recent repatriators, with France now storing all its gold domestically. Geopolitical risks, we've got sanctions, fears over repatriation access, is driving them to reduce their reliance on London and New York vaults. However, not factored into this, and other similar reports that are out there now, is that both the yuan and the ruble are 1-to-1 convertible to gold. And as we drew attention to in our February Live from the Vault liquidity provider report, in addition to silver and gold export controls, Russia and China are actively monetizing silver. Trade flow analysis backs up that Russia is monetizing physical silver as a reserve asset for trade settlement. In addition to the Russia Central Bank reported 500 tons of gold produced in 2025, Russia produces systematically 1,200 tons of silver per year. That's what they produce.
So what he's saying is gold. Russia and China are now on the gold standard. They're 1-to-1, their ruble and their thing. So yes, it's happened. Tremendous demand for silver. So if you have physical, what drives the price down? No demand. You don't have to worry about that. Russia and China and India and most of the BRICS, Saudi Arabia, Dubai are all buying the shit out of gold and silver because they know the dollar is worthless. But you're not hearing it here because they won't tell you that we fucked up and we've ruined the dollar. But that's what's happening. So you watch what China and Russia are doing. They're buying the shit out of it, and they're just waiting for this reprice. But they don't want to be the reason for China doesn't want to get blamed that the U.S. is broke. The U.S. can say it on their own. So that's why it's a little temporary, but huge demand, which should make the price go up in a normal physical market. All these options at 100-to-1 are just pure bullshit. So we're getting kind of caught in it, but we know it can't last because they're going to eventually have to come up with the gold. Like, so when they do an option and they're shorting it, China comes in and says, okay, I'll buy it. So you got to have a sell and a buy in the option, but I want to get the physical for it, which the U.S. doesn't have. And that's where it's going to end. They've got to come up with the physical, and China doesn't want the dollars. They want the gold, the physical. So that's kind of what's happening. So we're almost at the end. I know it's frustrating for everybody, but just hang in there.
Is exported. And we've been drawing attention to how the physically settled SGE physical gold and silver corridor has enabled this silver to be collateralized alongside gold as a high-quality liquid first-tier asset class because it's in a physical environment. Alongside gold, this means that the yuan silver and ruble silver is 1-to-1 backed with physical, consistently trading at a plus or minus 13% premium to London spot silver. All of this means the only central bank still short gold is in big trouble. And following the Fed's Bundesbank 2013 repatriation debacle, there's no other way of what an embarrassment, where the Bundesbank will refuse entry to inspect and even audit its US holdings. Then it was told it would take 5 years to return just 300 tons of gold, with some of those bars eventually returned as newly minted, not what was deposited, and mixed in with non-compliant melt gold to boot. So what we're saying is that's sufficient empirical evidence, along with other evidence, empirical evidence, that indicates that an unknown percentage of the 8,100 tons of US Treasury gold is either not there or it's hypothecated, which leaves the Fed nursing the residue of a 60-year bet against gold in a real quandary. And that's just putting it kindly. Okay?
Rehypothecated means we've sold it to China. So China's gold sitting in your Fort Knox, not US's gold. We've sold it already.
There isn't sufficient above ground physical supply for the Fed to go to market to buy back very large size of immediately deliverable bullion. It's just not there at any price, meaning a paper gold revaluation from $42.22, which is still out to market, would be the only solution. And that market price is probably going to be somewhere where a minimum of where the Shanghai physical price is, which is pretty much where it was at $5,000 initially, at $5,000 before we had the likes of the meme traders coming in and ramping gold up by $600 from that level. So essentially, what that means is that would be the minimum, and then obviously at that point, once it's revalued, obviously that price is then going to rise. Now, we got a lot of questions on exactly how a US Treasury gold revaluation would likely play out. And while the mechanics of this only requires just a very simple keystroke gold revaluation account adjustment, just wind of an upcoming revaluation would gap the global spot gold price probably hundreds, if not thousands of dollars higher. So they're going to avoid that. So as we previously outlined in more granular detail in other episodes, it would be affected over a weekend based upon benchmarking a Friday closing price, after which a higher bid-ask gold price would be quoted into the Monday open, clearly at a substantially higher price than benchmarked. And this would just suit the Fed, who would join the PBOC, the Bank of International Settlements, and every other global central bank in being supportive of a rising collateralizable gold price. There'd be no need for gold to be synthetically fixed above or below its true physical demand, supply-demand price, which is going to be established in exchanges where to own a bar, you have to own a bar to sell it, and you have to pay for that bar to receive it. So what this is a warning to the likes of Jane Street, who through massive comex and OPEX leverage have turned gold and silver into acting like meme stocks. In February, overshoot to the upside, and as most recently evidenced, overshooting to the downside. There's little doubt the House will get the nod ahead of this Friday event, but non-member unhedged useful fools would very likely to be caught short, may be given the grace to settle, especially as the brokers, we've seen 2 broker events where they've collapsed the brokers that would cause a banking crisis. So perhaps they get left off the hook. But non-member unhedged useful fools would likely get caught short. As we know, wrong-footed option writers get carried out feet first, carefully managed by the Fed and the House. The House is long or Basel III and SFR hedged. The COMEX House, they themselves would avert a default. So 60 years of rehypothecated gold would be keystroke squared, and ongoing gold hedging borrowing costs would have to reflect this physically deliverable price, not what we see now. As we highlighted in our last episode, skirting and leveraging up CME's already minuscule 0.049%, under 0.5% paper gold borrowing costs. We're seeing that now. And position concentration limits being violated. Unrecorded predatory OPEX traders, such as Jane Street and some others, write very large options positions that force the CME LBMA market makers to take the long or short side. They are market makers. They have to. Now, when these related algos suddenly pull the plug on unsuspecting COMEX traders, this leverage can temporarily exceed 150, possibly more like 200%, in turn creating upside or downside air pockets, while these hidden OPEX actors appear to stay within regulated position limits, but only after they ring the register on regulated futures positions. And they stay right.
That's why we see these big $80, $90 drops in gold when it makes no sense, because the price only drops if there's no demand, and all we hear is all the demand from China, Russia, BRICS, basically. Look for this maybe July 4th, not 100%, but they want to come out with this treasury, gold-backed treasury, 100-year, whatever crap that is, or 50-year. That is a weekend, so it could be coming up July 4th, and they'll revalue gold. Hard to say, but it might happen then. It is a holiday weekend, and that's kind of what they do. You go Friday, and it closes like today, and it opens Monday much, much higher. So that's why we buy as much gold and silver as we can and just hold it. We don't wait for the fire to break out to insure our house. We insure our house before the fire breaks out. And that's really the key to it. So let's see what happens July 4th. Maybe it will, maybe it won't, but it'd be nice.
Off the radar, we went into more detail on how they did it last time. Now, while this position concentration game was solely in the hands of officials and insiders, it's now being copied by non-cartel emulators, ironically serving to fast-track the COMEX's demise, where, as evidenced by all-time low open interest levels, all the real money central banks, sovereigns, and institutional hedgers and traders have migrated to where they can operate inside a siloed, true supply-demand, high-quality liquid asset physical environment, where they can actually reliably collateralize their positions. They don't care if they don't want the volatility. They just want to know what the physical price is so they can trade and collateralize it. And like any other card counter, the house will throw the likes of Jane Street and other non-member cartel emulators under the bus. I say good riddance. Now, especially...
So hopefully that happens soon, because this is getting really frustrating. 4,300, 4,000, 4,100, when it should be 5,000, 6,000 right now. This is just crazy.
As this leveraged COMEX-driven paper-to-physical disconnect is getting far too obvious to ignore. With gold coiled between key technical levels, the ingredients for a violent move falling into place.
All right, Andrew, what are you seeing on the ground as we speak right now today, Wednesday?
Yeah, I promised you what we'd see more immediately. And really, to best illustrate, let's dive into the chart and look at the chart footprints, because they reveal an awful lot. Now, just for the record, I'm recording this about 2 hours before FOMC, after the PM fix in Gold Fix, and this will be published tomorrow. So I'm trying to keep it as current as possible, allowing time to produce the episode. But this will be released tomorrow. So let's have a look. Really, it's all about the chart footprints. Lower percentage-based margin borrowing costs have enabled momentum participants to keep using short profits to continuously double down all the time, enabling them to keep adding more and more leverage 100% to one bubble short supply, creating a meme-like short sold condition. Now, last Tuesday's, and I'm drawing attention to this, future-centric gold and futures short selling salvo was deliberately timed for London PM fix and for liquidity to thin out after the foreign exchange gold market cleared for the day. Now, this is gold, and this is exactly where London cleared, and this is silver, exactly when London cleared. I'm just giving that as reference. Now, this selling had by Thursday run completely out of sufficient bandwidth to paper over an accrual of very large Asian physical gold demand. Now, lower percentage-based margins enabled momentum participants to expand native short open interest. And as we drew attention to in our last episode, was creating the inverse of a prior naked long condition, which was between 5,000 and 5,600. And this is when a series of margin calls, basically margin calls in gold and in silver, all timed together, were literally called in. This was just before they converted from a fixed margin call into a percentage-based margin call. And this is what popped this 100 to 1 naked draw bubble into the 56.2680 gold futures high, and in silver into the 121.785 gold silver futures high. Now, what I want to draw attention to is last Thursday, and this is the low marked last Thursday, this officially driven chart-painted bottom fishing expedition drove gold futures into an unsustainable 2008, November 2008 style bubble short disconnect, where the $680 lows commanded extremely large PBOC premiums, driving a gold revel that tripled in value. Literally tripled, 190, nearly 200%. And just as it did then, into this Thursday low, this officially driven paper to physical divergence had reached the point of an imminent, very large short squeeze. And as we've seen every single morning without fail, Asia comes in and buys every dip, even though they were beginning to selling every dip which they had into that Tuesday sell-off. And they came in, and what did it do? It forced the commercials exposed to T+1 delivery obligations to start to reel in the momentum shorts before Asia consumed yet another tranche of their short cover. Now,
okay, it's a little hard to follow there. So let's go to a better section. Where are we at? 25.
accumulations, while much larger unreported monetary gold accumulations flowing into Beijing continue unabated. Also, the latest data for the unwrought non-monetary gold imports, that is, like Doré bars, unrefined gold, it hit 86.7 tons in April alone, 81% higher than March. It's stepping up. They are grabbing everything in place, with June imports currently assessed at even higher record levels. Now, we're recording this episode just ahead of FOMC today, so we fully anticipate the synthetic actors. They'll be hunting out margin stops, I can see already, looking for little stops that might be upside, downside, so it's stuff they can rinse. And so we fully anticipate them to do this, which they always do in a synthetic market. But we, along with all our Asian-facing liquidity providers, see this as just one more opportunity to convert underpriced paper gold and silver into physical. I mean, the only question left is to ask, how prepared are you for the next debasement leg of your fiat currency to unfold? I mean, central banks and sovereigns have openly stepped up, swapping depreciating dollar-related fiat for physical gold and silver. And I personally know many of our subscribers are too. That's the only question I'll leave you with.
All right, that wraps up another episode of Life in the Vault, brought to you by Kinesis Money.
The likes of these Jane Streets and these momentum traders, but literally they were targeting that. And it was deliberately designed to create the narrative that gold is no longer a safe haven asset. And as the leaked WikiLeaks memo outlined, and as we've experienced into every single bullish for gold news event over the last 60 years, always, soon as there's an event, huge swathes of counterintuitive 100-to-1 leveraged paper gold supply is instantaneously dumped into the futures markets to create the illusion that the dollar is a better hedge, better safe haven hedge than gold. And we've seen it for 60 years. And the Fed openly admits intervening in other foreign exchange markets in coordination with other central banks, as we've currently coordinated at the moment. We've got dollar-yen interventions. But because gold is the long or short side of a foreign exchange cross, inflating the dollar against the gold is really, it's intended to dissuade foreign central banks from swapping their unbacked dollars for US Treasury gold. It worked when there was no central bank competition, but now there is. And as this massive physically backed Shanghai futures market premiums have revealed, we just looked at them, and when they are turned up, this time interventions are backfiring. And while this rigged official capping tool has been employed repeatedly over the years, the leverage to unleveraged paper to physical imbalance ultimately becomes so stretched it reaches an inflection point. We've once more reached the point where unleveraged commercial T+1 delivery obligations are overwhelming 100-to-1 paper supply. That takes a lot. And it marks the point where the House calls in the short bubble before Asia consumes its short cover. Now, after losing control of the synthetic price-setting COMEX tool,
Paper.
the unfactored black swan US-Iran war event, really what it did is enable the Fed to aggressively lean into this historical re-engagement of synthetic dollar oil bond yield mechanical correlations, which, plus 100 days into the war-driven volatility, provided Western-facing traders the illusion that gold had lost its safe havens status. However, while this fake narrative has cleaned out every single rinsable paper long, alongside incentivizing a 100-to-1 bubble bet against gold, it has set up blue sky, physically driven run into all-time highs with no leverage longs on board. However, while bubble short momentums have provided officials with a degree of leverage short cover for the last 19 months, the PPOC has openly been taking the long side, officially averaging 10 tons a month, as it once again reported by Bloomberg, at this rate of uptake, that's 85% of the 12 tons of Fed-borrowed BIS gold sales were officially bought by the PPOC. And liquidity providers assess that the June data will reveal substantially larger official Beijing accumulations, while much larger unreported monetary gold accumulations flowing into Beijing continue unabated. Also, the latest data for the unwrought non-monetary gold imports, that is like Dory bars, unrefined gold, it hit 86.7 tons in April alone, 81% higher than March. It's stepping up. They are grabbing everything in place, with June imports currently assessed at even higher record levels. Now, we're recording this episode just ahead of FOMC today, so we fully anticipate the synthetic actors, they'll be hunting out margin stops, I can see already, looking for a little stop that might be upside, downside, so it's stuff they can rinse. And so we fully anticipate them to do this, which they always do in a synthetic market. But we, along with all our Asian-facing liquidity providers, see this as just one more opportunity to convert underpriced paper gold and silver into physical. I mean, the only question left is to ask, how prepared are you?
Right. I missed that part. That's why we did it. So basically, you're seeing the gold price, the paper gold price go down. That's why I say paper gold and silver in the titles usually. So you've seen this price go down, and then they're trying to sell it like, oh, well, gold's nothing, and you don't want to hold gold because they can't tax you on it. There's no tax. We bought gold at $1,700. It's $5,000. I don't pay a nickel in tax because it just went up. There's no capital gains because I didn't sell. So I don't pay a nickel. And that's really my income for the year, is watching the gold price go up. I just made all this money and I don't pay a nickel in tax. And nobody knows I got it. It's beautiful. So they don't want you. They want you in the system. They want you in the stock market, in the banks, all these evil places that you're going to go broke in. For your retirement, if you're in the stock market, what are you going to do when it crashes? Which it will. All this AI bullshit is the same as analytics. It's all bullshit. And this is the thing. And gold's going to go up. It's going to get revalued. And COMEX is about to end soon. They're on their last leg. I don't know what this Jane Street is now. Why don't we take a look and see what Jane Street is? Jane Street is a multinational quantitative trading firm with global liquidity provider acting as middlemen behind the scenes of financial markets. It trades thousands of different assets like ETFs and stocks to make markets and facilitate trades between buyers. So it's a market maker, which is like when you sell 100 shares of Coke, you're not selling it, let's say, to Bobby who wants to buy it. I'm selling it to the market maker, who is then, Bobby wants to buy it. He buys it from the market maker. He doesn't buy it from me. So they're doing the same thing with gold. The firm is famous for its highly mathematical, puzzle-solving culture and unmatched profitability. Don't know about that. So they're a market maker. So they're the ones fucking around with gold right now. So they're taking these trades and then trying to sell them, and so it's a bad thing. Anyway, there was one other one, but I don't have time. Well, maybe we'll quickly do it. How GM destroyed itself. And the reason I want to show this is because it's all about understanding what the market is. If you don't understand your market, you're going to get fucked, right? Who am I selling baseball picks to? People that bet baseball. Is there a market for it? Well, we'll see. We know there's a football market. You know, I'm going to sell the coffee mug. Is there a market to buy a Jack Nicklaus beer golf course up north? Is there a market for it? And there is. Is there a market for apples? You know, yeah, people want to eat. There's more markets for food because everybody has to eat. So this is why GM went bankrupt, because they didn't know what they were doing. They didn't know who their market was. So let's quickly do like about 5 or 6 minutes of this.
In the wilds of Michigan, billboard lawyers hunt their prey. Big hair, bold promises.
In the 1950s, more than half the cars on American roads wore a GM badge. General Motors was the first corporation in history to earn $1 billion in a single year. With 600,000 employees and factories stretching across Michigan and Ohio, there was a famous saying back then that what is good for General Motors is good for the country. But by June of 2009, General Motors filed for the largest industrial bankruptcy in American history. The United States government had to inject $50 billion just to keep the company breathing. So how does the most dominant automaker on the planet destroy itself? Not with one catastrophic mistake.
So why did they bail them out? If your company can't make money and goes bankrupt, you lose. This whole bailout thing's ridiculous because we pay it, the taxpayer. Where do they get the money? They just print it out of thin air. Here's $50 billion. I mean, this is bullshit. You should not be bailing out the banks, and you should not be bailing out GM. There's no reason to bail them out, any of these people. They don't know what the fuck they're doing. They shouldn't be in business. You don't like, oh, well, you lost, so here's your money back. Yeah, I'd like to go to the casino, lose $1,000 on a football game and say, well, you know, come on. The guy got injured. Okay, here's your $1,000 back. What kind of crap is that?
But with decades of them. It was 1908, and a flamboyant salesman named William Durant had just founded General Motors with Buick as its only brand. Within 18 months, Durant snapped up 30 other car companies, including Oldsmobile, Pontiac, and Cadillac. The acquisition spree was breathtaking, but it also saddled the company with debt it could not repay. By 1912, General Motors bankers had forced Durant out the door. His replacement changed everything. Alfred Sloan was a stiff, detail-obsessed engineer who understood something Henry Ford never did. Ford wanted to sell one car to everyone. Sloan wanted to sell a different car to every kind of buyer. Chevrolet for working families, Pontiac for the upwardly mobile, Oldsmobile for the quietly comfortable, Buick for the ambitious, and Cadillac for the wealthy. A car.
So look what they're doing. They're hitting 5 different markets, right? The Cadillac people, but the Chevrolet people, and then the Buick and the Olds. So they're hitting 5 different markets. It's like, there's Mercedes, you want the high end, and then there's Ferrari, but then there's Toyota and Ford. So they're all different segments. And what GM was doing was hitting 5 different markets, which was very smart, provided you could make sales enough to keep them all profitable. And as it turns out, of course, they couldn't. But you didn't have Toyota and Honda and the Audi and the German companies to compete with. So right now it was just there's nobody there. There's Ford with the Model T, and then you came out with 5 different ones, and people go, yeah, I don't want the Ford Model T. Ford helped the Nazis. I don't want to buy his stuff.
For every purse and purpose, as Sloan himself put it. It was one of the most brilliant business strategies in American history, and it worked. By the mid-1930s, GM had overtaken Ford entirely. By the 1950s, the company controlled nearly half the American automobile market, and its factories stretched across Michigan and Ohio like an industrial empire. However, dominance on that scale creates a kind of blindness, and GM was about to prove it. GM also pioneered features that defined the modern car, including automatic transmission, power steering, power brakes, and independent suspension. And perhaps most importantly, they were the first automaker to change styling every single year, training an entire generation of Americans to trade in their cars regularly. Friday nights in the 1950s meant families walking showroom floors to see the new models under fluorescent lights. GM did not just sell transportation. It sold aspiration and status, and the idea that next year's car would always be a little better than this year's. The machine was printing money. But here's the detail that explains everything that follows. At its peak in the 1950s and 60s, GM employed over 800,000 people worldwide.
Jesus.
Entire towns in Michigan and Ohio existed because of a single GM factory. The company had its own in-house parts suppliers, its own finance arm, and enough political weight that its leaders moved between the boardroom and the White House without missing a step. And that success planted the seeds of everything that came next. Because when you dominate a market that completely, the most dangerous thing you can do is assume you always will. The first crack appeared in the 1970s, and it arrived on a cargo ship from Japan. Toyota and Honda began selling smaller, fuel-efficient cars in the American market, and General Motors executives barely noticed. When they did notice, they dismissed the imports as cheap vehicles for buyers who could not afford a real American car. That dismissal became an expensive habit. Then came the oil shocks. The crises of 1973 and 1979 sent gasoline prices surging, and suddenly millions of Americans needed something General Motors could not build: a reliable, efficient, small car. Japanese automakers had spent years perfecting exactly that. They won the subcompact market not just on price, but on something General Motors had stopped caring about: quality. A Harvard management professor named Rosabeth Moss Cantor wrote in 1984 that General Motors had become the object of suburban dinner table scorn. Everyone she met had an anecdote about why American cars were losing to the Japanese, and cost was rarely the complaint. The issue was that a Honda Civic simply worked better than a Chevette and lasted longer doing it. Meanwhile, General Motors was fighting a second war it kept losing: labor relations. A massive strike in 1970 pulled 400,000 workers off the job for 67 days and slowed the entire American economy. To prevent future shutdowns, General Motors bought peace with increasingly lavish contracts. The pay and benefits packages became so generous that the company earned the nickname Generous Motors. By the 2000s, retiree health benefits alone added roughly $1,200 to the cost of every single car General Motors produced. Toyota did not carry that burden. Neither did Honda. Every vehicle rolling off a General Motors assembly line started the race with a financial handicap bolted to its price tag. General Motors' market share began sliding, and the company's response was to make things worse. Which brings us to Roger Smith. Smith became chief executive officer of General Motors in 1981, and he inherited a company in trouble. General Motors had just posted its first annual loss since the early 1920s. Quality complaints were piling up, and Japanese competition was no longer a minor irritant. It had become an existential threat. Smith decided that the solution was technology. If Japanese workers were more efficient than American workers, he would simply replace the workers with robots. Over the next decade, General Motors spent roughly $90 billion trying to automate its way to competitiveness. The vision was something called the Lights Out Factory, a plant so automated that the only human employee would be a security guard. The reality was a disaster. Robots on the assembly line famously painted each other instead of painting the cars. Other robotic arms welded doors shut. Automated systems broke down so frequently that production slowed to a crawl. The whole program had to be partially dismantled just a few years after installation. What comes next?
Does that sound like AI? There'll be no employees and it'll all fuck up, right? That's what AI is going to be. $90 billion in the 80s was a lot. Now, the real reason is Toyota and Honda did not have to pay all the perks to the employees, cheaper wages. The medical was paid by the country. So they didn't have the same cost to the employee as the U.S. And you saw the unions, they're giving them more and more benefits, more higher wages. You couldn't compete with the Japanese and the Honda and Toyota. You couldn't compete with them because your costs were higher, and they're selling their car down here and you're up here, and the market's here. So there's nobody to buy the higher GM thing, and people aren't loyal. People bet with their checkbooks, and they're going, "Oh, this is much cheaper to buy a Toyota, and it lasts." And I remember I bought one in 1981, and it was great. I bought a Supra. It was the best car I ever driven. It would go 300,000 miles. You never had repair problems. It looked nice, and they never kept up with the looks, the GMs and the Fords. Hi, John C. How are you? So again, this is the market telling the GM to go fuck themselves because they weren't doing it right. And Roger Smith, instead of understanding what the market is, that my costs are too high for my labor, and to replace them with robots, again, it's like analytics. It doesn't work. You can't just replace it with labor. All right.
Is the part that still does not make sense. The irony is that Smith had the answer sitting right in front of him. In 1984, General Motors formed a joint venture with Toyota called NUMMI, reopening a mothballed plant in Fremont, California. Toyota sent its managers to train General Motors workers using the Toyota production system. Using that system, the same workers General Motors had given up on were suddenly building cars at world-class quality levels, and the lesson was impossible to miss. The problem at General Motors was never its workers. It was management culture, top to bottom, and Smith chose to ignore that lesson entirely. An auto industry analyst named Marianne Keller later summed it up perfectly. She said Smith thought Toyota possessed some kind of magic. The joint venture proved that General Motors management was the real problem. And if that were the only mistake Smith made, this might be a different story. But he was just getting started. Instead of fixing management, Smith went shopping. He bought electronic data systems from Ross Perot for $2.5 billion. Then came Hughes Aircraft for $5 billion. Lotus was next. He poured money into everything except the one thing that mattered, building better cars. The acquisition of EDS alone triggered one of the most public corporate feuds of the decade, with Perot and Smith exchanging insults through the press until GM paid Perot $700 million just to go away. That money could have funded an entirely new vehicle platform. Meanwhile, something quieter and arguably more damaging was happening across GM's showrooms. Badge engineering, the practice of taking one car design and slapping different brand names on it. A Chevrolet Cavalier, a Pontiac Sunfire, and an Oldsmobile Achieva would roll off the same assembly line with the same engine, the same interior, and nearly the same body panels. The only real difference was the logo on the hood. Customers noticed. If a $25,000 Buick was functionally identical to a $15,000 Chevrolet, why would anyone pay for the Buick? And somehow, it gets worse. Smith also pushed a controversial downsizing of GM's luxury models. The 1986 Cadillac Eldorado and Buick Riviera shrank dramatically, despite GM's own research showing customers found the smaller versions far less desirable. Sales of those cars dropped to less than half their previous levels almost overnight. GM's own...
So you're killing your markets. If I'm going to sell you a hot dog, because they want this particular, I can't change the hot dog and wonder where my market's going. So like I say, you can't sell the ribs for $45 a slab. You keep it at 30. You can't change. You've got your market, right? I sell teasers in football. I don't change. That's my market. People who want teasers buy it. They make a lot of money. And that's the key. I don't change it. I'm adding baseball, but I'm not changing the football. The football has remained. I'm just adding the baseball. And, if I'm selling green shirts, because it has a sailboat on it, a Nautica, then I keep making them. And I keep same design, same colors, what the market wants. The market controls everything, and the prices. The market controls the prices. You must respect the market. You can't start making changes and assume the market's going to go with it. It's not what the market wants. I want a slab of ribs. I want 13 ribs. I don't want 9 or 10, and you raise the price on me. Just a second. It's Alyssa. Yeah.
You done yet?
5-10 minutes.
All right, just call me right after you're done, okay?
Okay. Bye-bye.
All right, love you, bye.
So you've got to understand your market. What does my market want? And that's what you sell them. You can't change and assume your market will come with you. They won't. It's not, you see the prices, like I say, Oreos, right? They're like $6 for the package. Nobody wants to pay $6. That's why you see them 2 for $5, because the market's not willing to pay $6 for the Oreos, nor are we willing to pay instead of like 36 Oreos, 12 in a row, to now it's 9 in a row. It's 27 and pay more. The market's not stupid. You can't fool the market, but the market is your business. And if you can't satisfy the market, you got to get the fuck out of the business, because you can't do it. I see this happening in football, where I'm hearing on the radio where they're going to come and start doing more pay-per-view stuff, like baseball. Now it's ruining baseball is there's no games on regular TV. There's a Fox game like Saturday night, and there's an NBC game on Sunday night or something. But like now, if I want to watch Mizorowski, that game that should be on TV, and they're missing the boat, so it's not on TV. You can't see Mizorowski, you can't see Scanes. Like, well, what the fuck? And it's only in the local area, and they're missing the boat, and they want you to pay for the go pay for the NFL Network, or go pay for Amazon Prime. There's no demand for it. We don't want to pay to watch football or baseball. And if you start charging us for football, that's why it's still free on Sunday nights or on Sundays. You start charging us for that, we just leave. We just won't watch it. And your market's going to die, because you need people watching it. And if you think people will pay to watch it, you're out of your fucking minds. especially more people are my age, a little older, who grew up watching Saturday college football, Sunday pro football on regular TV, on Fox and NBC. And if you think it's going to go to Apple and Amazon, you're out of your fucking minds. You're changing the market, and you think people will go with. There's no demand for me to pay Amazon to watch a game. And if you think there is, you're out of your minds. It's not going to happen. And that's the thing. So you got to be careful with your market. You cannot start fucking your market and treating them badly, because guess what? When the market leaves, you're fucked. Who are you going to get? A new market? Nobody is sitting there. There's no demand. I talk about demand a lot. Is there demand for this coffee mug? This is the beer. It's a Jack Nicklaus course up at Lake Michigan where I go. And you can sell this mug for $20. I think I paid for it. But if you charge $40, ain't nobody going to buy it. But again, that's what a market is. Can I sell? Is there a buyer to buy this? So I'm going to sell this if there's a buyer. And the buyer says, I'll buy it for 20, but not anymore, because I want that golf course, or it's a Nicklaus or something. And that's what you got. This Barcelona. So I'm in Barcelona, and the question comes, well, gee, this is pretty, and I like plates, so I'll buy it. This was like 5 or 6 euros. If you priced it at 20, I wouldn't be buying it. But I like it. It's a nice souvenir. Oh, I was in Barcelona, and that was it. And I highly recommend the Picasso Museum if you ever go to Barcelona. It's by the lake or the sea or whatever was down there. It's by the water. And very, very nice, the Picasso Museum. That's where I get all. When you see the Picasso thumbnails, that's what you were able to take pictures. And then I just do that. Anyway, you can't fuck your market, right? You start overcharging, the market leaves you. You start putting these games on Amazon or Apple or whatever, the NFL Network. Forget about it. How many people watch the NFL Network for these Thursday night games? Nobody. And then they fake the ratings, because who knows what the ratings are, and they lie about those. Oh, 100 million people watched it. Yeah, bullshit. Based on what? Well, there's 100 million people that have Amazon, so I just assume they all watch the games. I mean, that's kind of what they're doing. It's all bullshit. Anyway, a little bit more GM. I got to go get Alyssa. All right.
Cars dropped to less than half their previous levels almost overnight. GM's own data told them not to do it. They did it anyway. Alfred Sloan had built GM's empire on the idea that each brand meant something distinct. Badge engineering and cost-cutting destroyed that distinction in a single decade. Customers who had been loyal to Oldsmobile or Pontiac for generations looked at what those brands had become and walked away. GM's market share, which had been close to 46% when Smith took over, fell to 32% by the time he left, and it never recovered. Now, in the middle of all this decline, GM did something extraordinary, and then immediately undid it. In 1996, the company launched the EV1, an all-electric vehicle available for lease in Southern California. It was built on a lightweight aluminum frame with a 3-phase AC induction motor, producing 137 horsepower. It ran on electricity, produced 0 emissions, and was one of the fastest, most efficient production cars ever built. A full charge cost about $3, and you could do it overnight in your garage. It required no oil changes, no mufflers, and practically no brake maintenance. The people who leased them fell in love with them. Celebrities like Tom Hanks and Mel Gibson drove them. Waiting lists formed. About 800 people leased EV1s, and their enthusiasm bordered on obsession. The car worked. If you are finding value in this video, consider subscribing. We cover automotive history and the stories behind the industry every week. But GM saw the EV1 as a compliance project, not a product. When the California Air Resources Board weakened its zero-emission vehicle mandate under pressure from automakers, GM pulled the plug. The company recalled every single
Yeah, but it was only 800. You got to sell like 200,000-300,000, not 800. So it wasn't prohibited to do it.
EV1 then crushed them. They flattened them in the Arizona desert. Lessees offered to buy the cars outright. GM offered $1.9 million for the remaining 78 vehicles. GM refused. Activists were arrested trying to block the car carriers hauling the EV1s to the crusher. Rick Wagner, who was chief executive officer during the final years of the EV1, later admitted to Motor Trend magazine that killing the electric car was his worst decision. That admission carries extra weight when you know what happened next. Martin Eberhard and Mark Tarpening watched GM destroy the EV1 and decided that since the big automakers would not build electric vehicles, someone else would have to. In July 2003, they founded Tesla Motors. 6 months later, Elon Musk became their biggest investor. GM had the technology, the manufacturing capacity, and a decade head start. They threw it away, and a startup built in a garage eventually became the most valuable car company on the planet. This is where the story takes a turn nobody expected.
That's bullshit. The most, they just sell their car for a lot. Anyway, I don't want to get into electric cars, but GM fucked up because they didn't listen to the customer. They changed markets. They changed what the market is. They hurt their customers. They didn't sell them what they wanted, and that's how you go out of business. That's how you go broke. That's where GM is now. And now they're trying to make electric cars, but there's no demand. There's no market for electric cars. Tesla sells a lot to China, which the guy doesn't say. So I don't really like electric cars. I think they're garbage because you're constantly charging them. They show you charge them in your garage. Well, what if I don't have a garage? Anyway, that's the problem. How does GM this is why companies go out of business. They don't understand their market. It's all about the market. What will your customer pay for? You must understand the price and what the customer wants. And you know what the customer wanted because you've had these 5 brands since 1908 or 1909. You beat Ford. Now they couldn't handle the competition from Toyota and Honda. They didn't adjust for it. And the people in charge are idiots. Roger Smith and this other Matt Millen of the Lions. This is the problem. You have idiots in charge, you're going to get fucked up. That's why the teams with the good coaches win. Lombardi and Bill Walsh and Bill Parcells and Joe Gibbs. That's why they won. They had good coaches and they could beat the competition. And GM does not. Neither does Ford. Ford's guys are idiots. They can't compete. They've never been able to compete with the Toyotas and the Hondas and the Audis and Mercedes because they just don't get it. And no, the electric cars are not the answer. They might have had one. They sold 800. Okay, hardly good, but there's no demand for it. The market is for gas cars, and it still is. And in China, it works because they're short trips and they have these bullet trains and stuff like that. So you're really not driving the way you are here. But here, like I'm going to go up north, I wouldn't take an electric car. If I needed to charge it, where would I charge it? In the woods? So I'd be stuck and I'd die in my car and I wouldn't be able to open the door. So no, the electric car I don't like, or it catches on fire, or I'm constantly charging it every day. I got better things to do than charge my car every day. I can fill it up and not have to worry about it for 2 weeks. Anyway, so that's about it. That was a show on markets. It's very easy. What does the customer want? And you keep the customer satisfied and you will have a good business. And if you try selling things that there's no demand for, you're fucked. This is where Vegas is going under. Oh, let's charge resort fees. There's no demand to pay. I'll pay for the hotel room $80, but when you hit me with $170, I don't want. Then you're killing your customer. Or let's pay for parking. There's no demand. Oh, let me pay for parking. Nobody wants to pay for parking. That's bullshit. You want me to come in, you don't charge me for parking. You go to Kroger's, you charge for parking there. If you did, you wouldn't go there, right? You'd go to Meijer's or Walmart's or something. So you can't charge. That's part of doing business. I was at the grocery store and I grabbed some cherries to taste them. And I said, there's this lady next to me. I don't know who she is. I says, well, did you try the cherries? She said, no. And I was eating them. I said, that's the cost of doing business. You've got to let me try it to see if I want to spend $4 on a bunch of cherries, $4 a pound. You got to satisfy the customer. So high liquor prices, high food prices in Vegas, there's no demand for that. Yeah, I want to pay $25 for a beer or $30 for a hamburger. Yeah, I don't think that's going to work. Who are you selling to? Who is your market? And this is basically Vegas's problem. They don't know who their market. Well, we're just selling to whales. Oh, really? And how many whales do you think you have there? 20 a year? I mean, whales don't want to lose their money either. And they just assume if they're a whale, they go to China, Macau to gamble where they can play everything and get comps and get good food and cheap liquor and don't have to pay for parking and all that shit. So that's kind of where you're at. Anyway, that's it. Your free pick. Take Steve Schittler for the Yankees and take the Mizorowski. We're going to go under with Perez against Atlanta, under 7.5. Those are your two free picks. I couldn't resist Mizorowski. Normally you just bet him, but if he's facing Scanes, and that would be a great game, you bet it under. Who's going to score? Where are you going to get the runs? You can't hit these pitchers. The pitchers control the games. Mizorowski, you're going to lucky if you get 5 hits. You're going to maybe score a run or two. That's it. This is Mizorowski. You're not going 4 for 4 that day. The guy who gets a hit's going to be the player of the game. Well, he hit a single off of Mizorowski, and that's what you do. So you've got to do that. So there's your free picks. But again, understand your market if you're in any business. And this whole thing with retirement, be in stocks. Well, they're not. You should ignore all those people. You want to be in gold. All right. I will talk to you later. Have a great day. www.teaserking.com. Hello.
Hey, are you done yet?
Yeah, I just finished.